Price doesn't move randomly. It moves from one pool of money to the next. And if you don't know how to see these pools of money, the market will look like pure chaos. I'll show you. So look at this market. It looks bearish. Lower lows and lower highs in price. So if you only read direction, you expect the next move to keep dropping. So when price breaks below this swing low, you short right under it. But then price snaps back above the same low. You and all the sellers who entered late are now trapped. Then price breaks above the last lower high. That one move tells you the whole story. Structure created the low. Liquidity was sitting below the low. The reaction after the grab showed the real direction. That is the map most traders never see. This is how market structure and liquidity connect. Structure shows the path price is building. Liquidity shows where orders are likely sitting around that path. The real trade idea comes from what price does after it reaches that liquidity. A swing high is not just a shape. A swing low is not just a line. Those points are places where traders make decisions. Now, before liquidity makes sense, you need to stop seeing structure as lines and start seeing it as trader behavior. Look at this 15-minute chart. Price pushes up, stops, and drops. I do not treat that top as a random candle shape. That top point becomes a swing high, which means it is a place where buyers fail to push price higher or where sellers defended the move. Now price drops, pauses, and bounces. That bottom point becomes a swing low. Again, it is not just a random low. It is where sellers fail to push price lower or where buyers defended the area. This is why market structure matters. Beginners memorize higher highs, but they often miss what those points mean. Every swing is a decision point. Someone entered there. Someone exited there. Someone placed a stop there. Watch this uptrend. Price makes a high, pulls back, then breaks above that high. After that, the pullback holds above the previous low. That tells me buyers still control the chart. Now watch this downtrend. Price makes a low, pulls back, then breaks below the old low. The next rally fails below the previous high. That tells me sellers still control the chart. Then look at this range. Price keeps rejecting the same high and bouncing from the same low. That is not random chop. That is a box where both sides keep defending their area. This is market structure. It simply means the way price builds swing highs, swing lows, and trend shifts. If price makes higher highs and higher lows, I read the market as buyer-controlled. If price makes lower lows and lower highs, it's seller-controlled. If price is stuck between equal highs and equal lows, I treat it as a range. Those structural points matter because they attract the orders that price often comes back to collect. So look at this clean swing high. This high is obvious enough that breakout traders, short sellers, and traders waiting for confirmation can all see the same level. That is exactly why I care about it. Above that high, breakout buyers may place buy orders. Short sellers may place stop losses there. Both types of orders create liquidity. Liquidity simply means orders waiting in the market. The best liquidity levels are usually not clever. They are obvious. That is the hidden edge. You are not trying to find the secret level nobody sees. You are marking the levels everyone sees, because those are the levels that attract stops and breakout orders. Watch this range. The top has been tested several times. That top holds buy-side liquidity, which means orders are likely above it. The bottom has been tested twice. That bottom holds sell-side liquidity, which means orders are likely below it. The chart that looked like a box now looks like a trap with orders on both sides. So if a high is obvious, I expect buy-side liquidity above it. If a low is obvious, I expect sell-side liquidity below it. If the level is buried inside chop, I ignore it. But finding liquidity is only half the map. The trade appears after price takes it and reacts. Watch this downtrend. Price breaks below an obvious low. And the question is simple. Does the break hold or does it fail? The candle closes back above the low. That tells me the breakdown failed. Sellers who shorted under the level are now trapped. And if price pushes higher, they may need to close. Then price breaks above the last lower high. That is the shift I was waiting for. Price pulls back, holds, and then runs into the next high. So remember this. The break below the low was not proof of weakness. It was the move that created trapped sellers. This is called a liquidity grab, liquidity sweep, or stop hunt. In simple words, price breaks an obvious level, takes orders, then comes back inside. This one looks similar initially, but it fails the test. Price breaks below a low and keeps closing below it. There is no fast return, no trap, and no shift above the last lower high. I don't call that a liquidity grab. This is a real breakdown. So what used to look like price broke support now splits into two different reads. One break holds and continues. The other break fails and traps traders. If price takes a higher low and quickly returns back inside the old structure, I treat it as a liquidity grab. If price breaks and holds outside, that is a trend continuation. And this is where traders get destroyed. They treat every break like a trap and every trap like a reversal. Look at this range high. Price breaks above it. Buy-side liquidity gets taken. A trader who just learned smart money concepts instantly shorts because liquidity was grabbed. That is the mistake. Price doesn't return inside the range. It holds above the old high. The next candle closes above it too. Then price pulls back into the old high and bounces. That is not a trap. That is acceptance above the old structure. Acceptance means price is comfortable trading outside the old area. In plain words, price broke out and stayed out. This break looks powerful at first, but the close tells a different story. Price breaks above the range high, wicks above it, then closes back inside the range. The next candle cannot reclaim the high. Buyers who chased the breakout are trapped. That is where trap logic makes sense. The close after the break matters more than the wick. A wick only tells you price visited the area. The close tells you whether price stayed there. The fix is simple. Don't fade the break until price proves failure. Remember this, a liquidity sweep is not the break itself. It is the failure after the break. Here is the clean gate. If price breaks a structural level and holds outside it, look for continuation. If price breaks and returns back inside, a trap just happened and a reversal is more likely. Now let's flip the map from single levels into full structure shifts where liquidity starts changing the trend itself. Look at this downtrend again. Price breaks below an obvious low and takes sell-side liquidity, which means it grabs orders sitting below that low. Sellers chase the breakdown, but price returns above the low. Then price attacks the last lower high, the swing where sellers defended the trend. When price breaks and closes above that swing, the old seller-controlled structure is damaged. That is the structure shift. The liquidity grab explains why price went below the low. The structure shift tells me the move may survive in the other direction. A market structure shift sounds complicated until you watch it happen after a trap. It simply means the old side lost control after liquidity was taken. This is the hidden rule. Liquidity explains why price goes there. Structure tells you if the move survives. The bullish version tricks traders from the other side. Price makes higher highs and higher lows. Then price sweeps above an obvious high and traps breakout buyers. If price then breaks below the last higher low, the old buyer-controlled structure is damaged. That is a possible shift lower. The labels come after the chart makes sense. Some traders call this market structure shift. Some call it change of character. The name is less important than the behavior. The old side lost control after liquidity was taken. The same pattern can fool you if you rush. Price can grab liquidity and bounce, but if it never breaks the defended swing, the reversal is not confirmed. In a downtrend, if price sweeps a low but never breaks the last lower high, I don't assume buyers control the market. So what used to look like the trend changed now becomes a test. Did price only bounce, or did it break the swing that defended the old trend? If price takes liquidity and then breaks the last defended swing against the old trend, I read it as a possible structure shift. If price takes liquidity but never breaks that swing, I don't assume a reversal. Now let's bring the full map together with another example that shows liquidity inside a trend, not just at reversals. So look at this clean uptrend. Price pulls back and creates a higher low. Traders buy that dip, and many of their stops sit below that low. A few candles later, price dips under the higher low, stops weak longs, pulls in breakout sellers, and then closes back above the level. The bigger uptrend is still alive because price has not broken the major swing low. Now I watch the short-term lower high from the pullback. Price breaks above it, and that tells me the pullback may be finished. The long idea comes after the reclaim and the structure response. Look, price continues higher and takes that high. Beginners often think liquidity only matters at major tops and bottoms. It also matters inside a trend. That is important. The pullback that scares weak longs out can be the same pullback that resets the trend for continuation. This is not the same as a full reversal. In a reversal, liquidity gets taken and the larger structure breaks against the old trend. In a trend continuation, liquidity gets taken inside the trend, but the larger structure stays alive. This bearish continuation looks like a reversal for about 10 minutes, and that is why it traps people. Pay attention here. Price is making lower lows and lower highs. I am treating the market as seller-controlled, while that larger structure holds. A pullback creates a lower high, traders short there, and their stops sit above it. Price sips above that lower high, traps breakout buyers, then returns back down and breaks the short-term higher low inside the pullback. That can fuel continuation lower. You see the difference? The chart that used to feel like a random pullback now looks like a cleaning process. Price removes weak traders, then continues in the main direction. If price is trending and sweeps a pullback level without breaking the larger structure, I look for continuation. If the larger structure breaks, I stop treating it as a simple pullback. Now open this chart with me. Price is pushing higher, then pulls back and holds above the last major low. I don't need to name every candle. I can see buyers still defending the structure because the higher low is holding. Above price, there is a clean high that every breakout trader can see. Below price, there is a pullback low where weak longs probably have stops. Now price dips below the pullback low. I don't panic, and I also don't short this new low. I watch the reaction. The next candle closes back above the level, which tells me the break failed. Now price pushes above the small lower high created during the pullback. That is the moment the continuation idea becomes real. The market cleaned out the weak longs, rejected the break lower, and turned back in the direction of the main structure. If price holds above the reclaimed level, I can plan around continuation. A range gives the same type of decision. Price is boxed between equal highs and equal lows. The top holds buy-side liquidity. The bottom holds sell-side liquidity. If price breaks the top and holds above it, I respect continuation. If price breaks the top and falls back inside, I read it as a possible trap and a reversal to the lower range. Here, price is sitting between the last swing high and the last swing low. I do nothing yet. There is no trade until price reaches one of those exposed areas and shows whether the break is accepted or rejected. If structure, liquidity, and reaction are not clear on the chart, I don't force the trade. I wait for the market to make the next decision visible. The next step is learning how to turn this hidden map into a real trade setup after liquidity gets taken. You see, most traders read charts looking for patterns. You're about to read them looking for money, specifically where it's trapped and which locations price gets pulled toward every single day. These locations go from obvious to almost invisible, and the invisible ones are where the real edge lives. 4-hour chart. See this swing high from 3 days ago. Every trader who shorted that level has their stop sitting just above it, because that's exactly where the textbook tells them to put it. 1 hour, price is coiling just below it. And look, same level tapped twice now. That's 2 separate groups of traders with stops parked at the same address. The pool just doubled. 15-minute, momentum pushing hard into that level. Candles getting bigger. Most traders see a breakout forming and reach for the buy button. I see a buffet about to get served. Price spikes through. Every stop above that level gets collected instantly, and it reverses hard. That's the entry. Stop above the wick. Target at the next pool sitting below. That's just one location. There are others, and the ones nobody's talking about are the ones that keep printing. Remember this. Liquidity is a crowd of people standing in the wrong place at the wrong time. The bigger the crowd, the bigger the target. And your job isn't to join them. Your job is to watch them get run over, step aside, and trade what comes after. When you spot a level that feels obvious, that's where price is going to eat. The more obvious the level, the bigger the meal waiting there. From now on, every time you spot a level that looks too clean, too obvious, ask one question: who's trapped here? That answer tells you where price is going next. The most loaded pools on any chart are always the most visible ones, and that's exactly what makes them dangerous to trade the way everyone trades them. See this swing high. Every trader who bought the breakout above it has their stop sitting just below. Every trader who shorted it has their stop sitting just above. 2 completely separate crowds, both wrong, both parked at the exact same price. That's not a coincidence. That's a magnet. Pay attention to this. Retail traders aren't placing stops randomly. They're placing them exactly where every course, every book, every YouTube channel told them to, just beyond swing points. That collective predictability is what makes these locations magnetic. The more people follow the same rule, the bigger the pool. Round numbers work on the same principle, except the psychology is even more automatic. Most traders think placing a stop or target at $50 is discipline. It's a statistic. You're doing what every algorithm on every institutional desk is programmed to expect. These levels aren't support. They're packed parking lots, just waiting for someone big enough to drive through them. And the most consistent version of this resets every single day. Above yesterday's high and below yesterday's low. Fresh stops, fresh pending orders, like clockwork. I spent 8 months wondering why price spiked just above the previous day's high every morning before reversing hard. Kept calling it a false breakout. Took me an embarrassingly long time to realize I wasn't observing the false breakout. I was causing it, buying that level every morning like a very enthusiastic, very broke alarm clock. The market genuinely loved me. What used to look like a false breakout is actually a collection run. Same move, completely different meaning, and completely different trade. So swing points, round numbers, previous day levels. But here's what most traders never figure out. Every touch on one of these levels makes it more dangerous, not less. The pools underneath are the ones that have been building longest. That's where we go next. Pay attention to this level. Price touches it, pulls back, touches it again, pulls back. Most traders see strong resistance, a level the market has respected multiple times. Here's what's actually happening. Every time price touches that level and fails, a new wave of traders shorts it. New stops stack just above. The pool grows with every single visit. By the third touch, that level isn't resistance anymore. It's a dam. 3 rounds of stops, same location. When it finally breaks, it doesn't break out. It floods. 2 or more touches at the same level, pool is loaded. Hunt is being prepared. Trend lines are where it started costing me real money. First year of trading, I drew them obsessively, adjusting anchor points until they connected perfectly across 4 or 5 candles. I was proud of those trend lines, and I kept getting stopped out just below them. Different pairs, different time frames, same result, over and over. Here's what I didn't understand. The more textbook a trend line looks, the more people drew the exact same one. And the more people drew it, the more stops are sitting just below it. Because everyone learned to place their stop just below the trend line. That trend line isn't analysis. It's a treasure map with a giant X on it. You drew it, labeled it, and handed it to the market. They knew exactly where your money was. Chart patterns are the third version of this, and the most expensive, because the patterns are real. The problem is when a pattern is textbook enough for you to spot. It's textbook enough for every retail trader on the platform to spot, which means everyone's stop is in the same textbook location, which means the pool is enormous. I traded triangle setups for almost a full year, got hunted so consistently and so precisely, I genuinely started to wonder if my broker had my trading account open in another tab. I was just that predictable. So equal highs, trend lines, chart patterns, all traps built from other traders' education. But there's a deeper layer, pools that are invisible on the chart and far larger than anything we've covered. These are the ones almost nobody knows exist. See this last red candle right before this massive move higher. Watch what happens when price comes back to it. That candle is the location where an institution placed an order so large that executing it moved the entire market. But they couldn't fill the whole position at once. Think of it like needing to buy 10,000 Big Macs in a single afternoon. McDonald's cannot serve that in one visit. You come back multiple times throughout the day. Institutions work exactly the same way, except with billions of dollars and considerably less special sauce. When price returns to that specific candle, they are filling the remainder of the original order. Mark the last down candle before a major up move, the last up candle before a major drop. These aren't levels, they're addresses. Somebody important lives there, and they always come back. But there's a second thing most traders never see. The space above this consolidation. Above every prolonged range is a vacuum. Almost no orders exist there, because price never traded through it slowly enough to fill them. When price exits the range and enters that void, watch. No friction, no hesitation. Straight through to the next major pool above. The void is the road. The pool at the far end is the destination. And the largest destination on any chart is always the all-time high. Every trader who ever shorted it has their stop sitting just above it. Millions of accounts. Weeks, years of accumulated stops. That euphoric all-time high breakout everyone celebrates and chases. Be suspicious of it. The louder the crowd cheers, the more you should be asking, who is on the other side of every single one of those buy orders? So order blocks, liquidity voids, all-time highs, pools most traders never find. And there's one variable that separates a good level from an almost guaranteed hunt, and it has nothing to do with the chart. Liquidity isn't only about price, it's about time. The same level at 2 a.m. and at 9:30 a.m. are two completely different setups. And confusing one for the other is one of the most expensive mistakes you can make. The Asian session builds the range, 3 to 4 hours of low volatility, price coiling inside a narrow band. Stop stacking above the range high, stop stacking below the range low, both sides loading simultaneously. The Asian session is the market quietly setting the table. London walks in and eats. Almost every single trading day, the London Open sweeps one side of the Asian range first, before committing to the real directional move. I used to trade the Asian session exclusively, convinced I was finding clean setups in a quiet market. I was finding clean setups in a liquidity build. Every entry I took was adding fuel to a pool that London was about to collect. I was the table being set. Then New York opens and does the exact same thing to London that London did to Asia. I learned this one the hard way, held a London setup through the New York Open, stopped out within the first 15 minutes. New York doesn't care about your London entry. It has its own pools to collect first. Here's exactly what I'm scanning for on this one. Asian range built overnight. Clean equal highs on the upper boundary. Stop stacked above. London opens several candles away. Price pushing up into that range high right as the session opens. Within 15 minutes, price spikes above the equal highs. Every stop above that level collected instantly. Then watch. Wicks forming above, bodies closing back inside the range. The sweep is done. This is the setup I've taken more than any other, and the one that stopped me out the most before I understood what the sweep confirmation actually looks like. Enter on the reversal candle, stop above the wick, target the Asian range low sitting on the opposite side, pool-to-pool delivery. So swing points show you where the stops are. Equal highs show you how loaded the pool is. Session timing shows you when the hunt arrives. 3 things. Every setup. You're not reading support and resistance. You're reading a map of where money is trapped and which direction the market has to move to collect it before it can go anywhere else. That's a completely different game. But here's the problem. This entire system fails in one specific scenario, and when it fails hard. Price sweeps the level, you enter the reversal, and it just keeps going. No trap, pure continuation. And the candles that signal a real breakout versus a liquidity hunt look almost identical. That distinction is in this video, and this is exactly the kind of setup we break down inside our academy. See you inside.